Very good afternoon, friends. First of all, in this Income Tax Act developments video is the update on the new Income Tax Act comprehensive review or revamp. The news is that a major chunk of the Income Tax Act would be reviewed or revamped in this budget and balance going forward. But even in case we are talking of the Income Tax Act revamp, a major reform in the form of PAN 2.0 has already seen the light of day, and it has been approved by the Cabinet Committee. PAN 2.0 is making the PAN a universal identifier across government platforms, and certainly it will help the government to track evasion. However, it also seeks to provide relief to many of the taxpayers, and many of the taxpayers, specifically the deductors and the deductees of TDS, have applied and represented before the CBDT that why PAN and TAN numbers need to be different. In case somebody deducts TDS with the TAN number, then there is a huge hardship of identifying the PAN number of such deductor while reconciling the books. Now with this PAN 2.0, it seems that PAN and TAN services portals would be combined and unified, and therefore tracking PAN with TAN and TAN with PAN number would be possible with PAN 2.0. Similarly, the PAN and TAN numbers can be applied for allotted and even amended online on a completely paperless platform. So this PAN 2.0 going forward is expected to be a major game changer for income tax assessees. Even the income tax assessees can apply for the new PAN card going forward once this PAN 2.0 sees full-fledged implementation. Another issue for specifically the corporate taxpayers is that they are spending a huge amount of money on advertising, marketing and publicity expenditure. In international taxation, whenever there is a foreign spend, then this is questioned, and by and large, with the verdicts of many courts, the issue is gaining more regularity in international taxation. However, what in a case where a domestic company spends on AMP, that is advertising, marketing and publicity, and such spend on AMP also benefits its group company or its director? Can it be added back as a disallowance under section 37 of the Income Tax Act just because it is benefiting another group company or the director? Well, the Honorable Income Tax Appellate Tribunal Bangalore, in the case of Sara Sol, has held in favor of the taxpayer. It has held that in case business purpose and business expediency can be proved, then just because AMP spends are helping some other group company or the director, it cannot be disallowed. Similarly, all the employer taxpayers are deducting TDS under section 195 for their employees. What in a case of expats? Certain expats for the whole year almost they remain non-residents, and at the fag end of the financial year it is known that they have become residents. Or even otherwise, in case of impossibility, the TDS deduction is delayed, not spread out evenly during the year, and is thrust entirely in the latter half of the year. Can interest under section 201 1A be levied on this late deduction and deposit of TDS? Well, it was held in the case of Great Eastern Company Limited by the Honorable ITAT Mumbai that where the deductor is genuinely under the view that no TDS would be deducted and therefore the entire thing is delayed for the latter half of the year, then applying section 192(3), in such cases the interest under section 2011A cannot be levied. This judgment would help most of the employer taxpayers and deductors. Another issue for residents who are earning income abroad is that where they are paying taxes in a foreign country, they must get the credit of such taxes paid under DTAA. However, to take the credit under DTAA under section 90 read with rule 128, it is required that before the end of the assessment year, the form 67 needs to be produced and filed. What in case the taxpayer resident himself gets the form 67 after the end of the assessment year, or for that matter even inadvertently produces the form 67 later? In such cases, it has been held by various courts that the credit of the foreign taxes, which is a substantive right, cannot be denied for a procedural lapse of delay in filing form 67. Form 67 is directory and not mandatory, as has been held by many courts and reiterated by the Honorable Kolkata ITAT in the case of Jaspal Singh Bindra very recently. Not many a times it is seen that even in case the appellant is not represented in the courts pass a favorable order. In this form 67 case, in the case of Jaspal Singh Bindra, this was the case, and the ITAT Kolkata has held completely in favor of the appellant, even though none represented. Another anomaly, I would say, which was rectified by Finance Act 2023 is that in case interest is spent on borrowed funds for the purpose of constructing or purchasing a house property, then the deduction of such interest is available under house property under section 24B, and the same interest can be added as cost of acquisition under section 48 under the head capital gains. Whether the dual benefit is available? Well, from assessment year 24-25, while amendment to section 48, it has been held that where a deduction is available under 24B, then the same amount of interest cannot be added as cost of acquisition under section 48. However, what about periods before that? What about financial year 22-23 and before that? Well, the Honorable Apex Court in the case of Vegetable Products Private Limited had held that beneficial interpretation has to be given in case certain provisions, even though anomalous, are beneficial for the taxpayers. The same has been held in the case of Neveli Tuli by the Honorable ITAT Mumbai, and this double benefit has been allowed for assessment year 23-24 and before that. Therefore, all such taxpayers can still take the benefit for the earlier periods, which one may note. Well, section 68 and the family of section 69 is the talk of income tax recently. Section 68 is for unexplained credits, where assessing officers alleging that funds are circulated by the taxpayer by taking loans from one person and providing the same amount as a loan to another person. These amounts are added and a case is made under section 68 while invoking the higher rate of income tax. Well, many a times the documentary evidences like ITR of the lenders, bank statements, PAN cards, loan confirmation bank statements, and all other documentary evidences are also ignored. It was held by the Honorable Gujarat High Court by invoking the writ jurisdiction that natural justice and opportunity of being heard has to be provided by the AOs, even though faceless, and all such documentary evidences have to be given cognizance of while invoking section 68. The documentary evidences cannot be ignored, and therefore the matter was remanded back to the original adjudicating authority. So for 68 cases, one may refer to this Gujarat High Court ruling in the case of Shah Tobacco. So friends, these are the major developments in income tax in the last couple of days. Thank you very much for watching. Please do like, share and subscribe to this channel. Stay tuned. Thank you very much.